Hey everyone. As expected, the Federal Reserve held rates flat following their meeting last week. That keeps the Federal Reserve's overnight rate in the 5.25% to 5.5% range, and based on Wall Street's expectations, it's likely the federal funds rate will remain stable through January 2024. The challenge that's emerging, however, is that long-term Treasury rates, which are mostly influenced by market forces rather than the Federal Reserve, have been rising rapidly in recent weeks. The 10-year is currently in the 4.8% range, about 60 basis points higher than it was 60 days ago. That's important because the 10-year Treasury has a much stronger influence on both residential and commercial lending rates than the Federal Reserve's overnight rate, something I highlighted in a video a couple weeks ago. Since the release of my video focused on the 10-year Treasury, we've gotten a little bit more information. First, the Treasury Department announced that they'll reduce the size of their planned fourth quarter Treasury issuance by about 10%, from $852 billion to $776 billion. But $776 billion is still the most the Treasury has ever released in a fourth quarter. And second, to help alleviate pressure on the long-term rates, the Treasury will shift some of the planned issuance from 10 and 30-year long bonds to shorter-term 2 and 5-year bonds. This has already helped ease some of the pressure on the 10-year Treasury rate, at least for now. But the higher rates, together with rate uncertainty, are having an increased effect on the commercial real estate market. From what I've been hearing, the biggest challenges are not due to the wave of mortgage maturities. Maturing loans have a couple of advantages right now. First, the maturing debt likely originated 5 or 7 years ago, so the properties have likely appreciated and have more equity in place. And second, last June, the FDIC and the Fed issued guidance recommending banks partner with their borrowers in good standing to work out some sort of loan extension. So although maturing debt is causing some ripples in the market, and some of the properties with maturing debt are being sold instead of being refinanced, we have not seen a wave of distress hit the market due to maturing loans. However, rising rates are creating some other challenges. Properties purchased a couple years ago using variable rate debt and a short-term rate cap are facing the burn-off of their rate cap. And replacing those rate caps has become cost prohibitive. As a result, investors who purchased a property at the top of the market in 2021 or early 2022 using variable rate financing and a rate cap now face a problem. Either pay to replace the rate cap, which may cost hundreds of thousands or even millions of dollars, or move to the current interest rates, which could be 250 to 500 basis points higher than what the rate was before the mortgage rate cap burned off. I suspect that as more mortgage rate caps burn off, we may see more properties come to market. Properties that were acquired at the height of the market in 2021 and early 2022 may sell at a discount because cap rates have risen. Depending on the property type, location, etc., the discount may not be as substantial as many buyers are hoping. The hundreds of billions of dollars of capital waiting for commercial real estate investment opportunities will help sustain market liquidity and keep prices from falling dramatically. But there are still a lot of variables in play. The short-term economic and commercial real estate outlook are still very hard to predict. Much will depend on what happens with the 10-year Treasury, and that will be influenced by the Treasury Department, the Federal Reserve, and a variety of other factors such as how the conflict in the Middle East plays out, Congress's ability to get a budget in place by November 17th, and so on. That said, the longer-term outlook still appears favorable. The demographics remain good, as does the U.S. employment outlook and consumption. That's why investors, while considering the short-term forces, still need to focus on the longer-term outlook. And as always, investors need to keep their eyes on the horizon.